Should we stop buying stocks? And what do we do from here?
Because to me, it's like, it doesn't make sense. If I feel that, oh, I'm worried about this market for whatever reasons, then I still continue to buy. To me, that is like nonsense, right? That's just crazy. Why do you want to do something that purposely make you uncomfortable?
So welcome back to another episode of the Backholder Pod. I think increasingly, the markets are getting quite choppy. But even before markets started to chop, if you look around us, looking across all the indexes over the world, you can look at the US market, you can look at the Singapore market, the Chinese market, whatever markets. I think most of it, on a year-to-date basis at least, most of them are basically 45 degrees to the right. Notably, of course, you have some very standout performance. I think especially in the emerging markets that are related to semicon. I think you look at countries like, I think Korea, people that are related, they are up by a very large extent. Even US, given the recent slight dip, they are still up a respectable double digit this year. China, not forgetting the fact they came out of the bear market, they're up like 30-40% year to date as well. And even for our local Singapore market, it's basically carried by the three banks. I think they make up half of the STI index as well. And we are looking at potentially some concern about potential overvaluations. I think you can draw out any form of benchmarks you like to look at. People are comparing about our banks. You look at the price to book historically at some of the historic highs. You look at some of the defensive stocks, PE ratio also sky high. US market, I think you look at PE also sky high. Then there is this new narrative or new phenomenon that people are talking about. Hey, at the backdrop of all these markets going up, I think there's nothing wrong to start to sell some positions, to keep some profits, realize some profits, keep some cash, start to go defensive, stop buying stocks, look into other potential alternative instruments as well, so that you have the cash to take advantage of potential drawdowns in the future, potentially. Who knows? So I just wanted to get your view of, given this backdrop and context and people talking about, like, the long and short of it, if I can summarize, is basically trying to time the market, right? Because you think that you can position yourself well before any further market moves or market drawdowns. Just wanted to get your thoughts, Bunti, on, should we start to get defensive as well, considering this market backdrop?
I think there are two angles to it, right? Let's talk about the first one, which is, what's the strategy that you are running, right? Because you know me, I don't run the strategy of trying to circulate my money. Sometimes I feel that this sector is doing good, this market is doing good, that I just shift my money around and then I just shift the other side as I see, okay, the other side getting better, right? I just simply don't do this kind of things. And I will encourage all viewers who are watching this, if you want to learn from me, right, you also don't want to do this. Not to say that I don't do this, then my result is better. Maybe the result is just something else. I feel that if you don't do this kind of market timing, right, actually your attitude or your mental state when it comes to investing, right, will actually be a lot more like calmer. Like you just look at your investment holding, not so much about like, or the ticker going up and down. You look at it as like, okay, I treat it as like a business, right? It's almost like, or you are having a restaurant business, but you didn't operate it. It's just that someone you trusted operate it, but you are the co-owner. You won't think about like selling this restaurant and buy the other spa, right, center, right? So you would just, like deeply in love with your own business, right?
Maybe if I'm scared of an economy turning bad, maybe I would let it go. You think about it, right? So let's say I predict, or I'm seeing my sales going down. I feel like I don't know how to manage anymore. Then I start to go defensive. That's what I mean by, like, maybe you sell your ownership and then you hold cash first. Then so that's that comparison.
The question is that when your girlfriend's mood is not good, do you feel like, okay, why not I just find another girlfriend temporarily, right? The answer is no, right? So to me, it's like the way I look at my holdings is almost like I'm looking at my families already, family members. You don't swap out and swap in with your family members. Sometimes you really give up and then you just, like totally cut ties, right? That one could happen, but you don't temporarily go in and out just because there's some, emotional attachment, because these are your babies, right? These are your families, right? So that's how I see my investment holdings. That's why I don't do these kind of things that in and out. Of course, sometimes their mood is not good, and then, like moody, and then quarrel, and then you don't feel good about certain positions. I think that's all fine, but you shouldn't, search for alternatives just for that kind of reasons. That's how I feel. But that's about the style. Okay, all of us, we all have our own investment style. There's no right and wrong. You just have to okay with your own style, right? So that's one angle. The other angle about, like, do you want to sell now to hold some cash? I think that one is also depending on the viewers, right? Whether you are someone who is like still young, still investing, still saving, or you are close to retirement, right? Let's say if you tell me you are 60 years old and then you already stopped working and you are investing your pile of money and you are anyways 80% invested, you feel like you want to de-risk from 70% to 50%. To me, that's a good thing, right? Because you don't have active income. Why should you invest so much into all this risky investment? Because share price is risky and it's a matter of when you need to sell, right, to fund your expenses. So that one also is like which stage are you in? So that is also personal to each investor, right? So those two things aside, then now we want to talk about like individual positions, like whether want to talk about US, is it overvalued? Should you stay away? Or we talk about like Singapore stocks? We can go into all these details, but I can tell you just a general view is that for every stock or every market that you have seen, for example, let's say the performance is doing good this year, right? I can come up with some explanations to tell you that actually these things is fair. Not everything that go up means that it is overvalued or it is not a good investment. Sometimes the share price went up, right? It might be even a better investment just because the fundamental is different already, or the fundamental is like getting even better now. So there could be that kind of reasons, right? We can get into the details. Maybe we can start from Singapore banks.
Maybe before that also, I got one more broader question, big picture one, before we go dive deeper. So now what we talked about, like you said, quarreling, don't think about going in and out. That one I understand. So let's say assume that I already hold a portfolio going into this, I made good money. I'm not going to touch it, fine. But we all know as we are working, we still have income coming in. We spend lesser than we bring in and things like that. So assuming that, let's say I not dollar cost average. So I know that I can really predict that if you dollar cost average, you should stay the course. If not, you defeat the purpose of dollar cost averaging. But let's assume this guy now today is actively investing. Means that he manages the cash position up and down and things like that. And he has active income coming in, which will build the so-called cash pile. And he doesn't so-called actively rebalance between bonds and equities. So now the consideration then is, okay, I see everything high, I'm a bit scared. So then I just everything keep cash. So every new injection, I keep cash. And I also understand actually for yourself, you also went through that similar cycle, but maybe you started deploying as well, but you went through that similar cycle of trying to build cash buffer as well. So maybe walk us through that thought process on should we start thinking about it from this perspective that maybe I'm not expressing an explicit opinion that I'm bearish, but it's just all the new money come in, I just keep in cash, then see how it goes.
How I approach this is like there are like two different, directions that is pulling, right? Number one is that if you are feeling uneasy about the market for whatever reasons, it could be you did deep research and then you come to this conclusion that this whole thing is overvalued. We are going for corrections, right? And I mean, just stay with that, right? As long as you are feeling uneasy about it, right, then you shouldn't deploy your money. I mean, DCA aside, right? Because to me, it's like it doesn't make sense if I feel that I'm worried about this market for whatever reasons, then I still continue to buy. To me, that is like nonsense, right? That's just crazy. Why do you want to do something that purposely make you uncomfortable? And by doing that, right? For example, you say, I need to buy, I must buy. Or I'm feeling uneasy, then I buy. Then end up, I can predict the confirmed outcome is that you cannot sleep well. So that one is like, to me, it's like one angle pulling, right?
Okay, maybe the second angle you keep in mind first, right? I wanted to kind of jump in on this point. Actually, is that not the whole point of DCA? Today, if let's say I really
DCA is just
I
like
still need to buy.
To me, DCA, right, is like it's a form of system. DCA is like a rules, a system that makes sure that you stay disciplined, right? And if you really believe in DCA, right, you at least believe that these things, I trust this process. I don't trust the market timing part. Whether the market timing is done by myself or someone else, right? I just don't trust that. At least for the money that I committed to do DCA, I at least trust the process on that sum of money. It could be that I'm saving, let's say, $3,000 a month, but I did DCA $500 per month. There's no wrong to it, right? You can always do that. You can always say that there's one portion that I DCA regardless. The other pool of money, I want to do whatever I want. But the part that is like you are in the driver's seat and you are actively deciding when to deploy, right? And now you are telling me you are feeling uneasy about the market and you still want to deploy? I mean, that is like outside of common sense, right? You feel uneasy, you don't deploy, then you just let the cash build up. That is the natural course. I'm not saying this is the optimal decisions. That is just common sense, right? Then that's one angle. I need to finish up with the second direction, right? The second direction is very simple. You do this often enough and you do this with the scale that is is big enough, meaning that you really save, and then you look at your balance sheets, right? Your personal balance sheet, you just compile all the cash that you have, all the stock position that you have. Suddenly you realize that, oh, actually I'm investing 10% only, 90% in cash. Then the next question is that your cash now earn you how much? Then you are saying that, oh, the cash with all sorts of credit cards, things that you are doing now, you're earning, for example, I don't even know what's the right number, right? For example, 2.5%, right? Okay, you're getting 2.5 CPF OA sum. Then the next question I tell you, do you really know that over the long term, the inflation is much higher than 2.5%? You can safely assume it is 4%. You won't be much lower than 4%, I can assure you, right? Then you are actually losing money on real term basis, meaning inflation adjusted, right? And if you do this like big enough, meaning that like 90% into cash, and do this long enough, say for example, 5 years, 7 years, you have this kind of cash drag, right? Then your financial positions is just like, I wouldn't say that bad. I would say that it's very, like, how to say, not optimized, not optimal. You are doing yourself a disservice by having this kind of position. And it is quite normal for people stuck into this kind of situation, especially if they feel that, oh, market is already overvalued. Then from that point, maybe they sold a position and then market just rally another 30% from there, right? Then they start to anchor on that level when they sold, right? They are not able to buy it back unless it really dipped to that level. And with that, right, if you just have like 2 years of bull run, right, maybe it's like quite hard for you to buy back with that anchor price that you have. Then you become stuck, like every dollar that you save, right, you can only put in cash because you need to buy it back at a higher price compared to the price that you just sold, right? So that one, it becomes like a psychologically you suck into it, and then your entire financial position, your balance sheets, your portfolio become haywire already. And if you realize about that, you can still fix it, right, by just saying that, okay, fine, I'm just going to reallocate. Maybe I start from 10%. To me, maybe not comfortable to go to 50%, but at least I fix it actively, right, by deploying, moving up to 30%, 40%, still okay. But if you that anchoring stay too long, right, some people do this for like 20 years. They just save cash because of what 1997 they feel bearish about things, and then it just rally 50% from there. They can't buy it back. I mean, that kind of reason. I mean, for those who experience these kind of things, I think you will understand what I'm saying. Is the anchoring part is actually quite strong one. Many people suck into these kind of things one.
I completely agree in terms of, because ultimately, right, even in the game of investing, on one hand, very mathematical, like a lot of calculation because it's finance, right? But on the other, there's also that part about behavioral finance.
Yep.
The behavioral part that sometimes you also cannot explain. It's just how things are done, how human psychology is. That's why people create systems like dollar cost averaging.
Yes,
So
exactly.
now you give me this two direction, right? But you never tell me the answer. So how do I look at this? On one hand, you say if you feel uneasy, you should keep it in cash because you feel uncomfortable if you sleep well at night. On the other hand, you tell me if I keep too long, then it will cash drag. Then maybe I don't want to jump back or anchoring bias. So what's the answer? There is no answer here.
That's why I say these two things should guide our viewers who is watching this, because I'm providing the framework. Okay, I'm not providing like you should do this and that, right? Because framework is like you can generalize, you can use it. Then you need to apply to your situation, whoever watching this, right? But I can explain my situations right now because I also experienced this, right? Because I know that having too much cash, it will be a drag to my portfolio. But if I keep deploying, I need to look at the market, because not too long ago, market is still like quite how to say, overvalued. And in fact, I did create some video to say that actually, if you look at forward PE or whatever metrics that you can look at, right, especially for the US market, yes, it is kind of overvalued right now. I won't call it bubble. To me, bubble is like, oh, everyone just buy, you are you don't buy, you are losing out. That kind of formal things, to me, that's bubble, right? But now it's like overvalued, but not to the bubble stage, right? With that, I will say that, oh, just because of that, maybe there will be some sort of like correction, then I can deploy at a more attractive level. Then that's where the cash come into the picture, right? That's why I also have some cash. I don't recall the exact percentage, but I do have some. But let's say if now market continue to go down, I might deploy in a more forceful manner. But I mean, all these things is quite fluid one. I won't exactly tell you what I'm going to do, but I would say that the guiding principle is basically these two things. I shouldn't have too much cash because of the drag, and at the same time, I need to have some sort of buffer for me to deploy when I see that the valuations or the opportunity is a lot better.
I think not only that, I think one very important context as well. So Bunti talk a little bit more about risk tolerance, talk about how comfortable you feel, and potentially even your age, right? But one more important factor is also the time or the length of the person in the markets already. So if somebody that have accumulated positions that are a lot cheaper, they don't feel as bad, you see, because their cost price is low. Now they've all rallied quite a bit over the last 4 to 5 years, assuming they invested since COVID. Now, even if it draws down, if they continue averaging up, I think it's fine. They can continue to take advantage. I think psychologically speaking, it's easier for them as well. Compared to somebody that just fresh entered into the market, he has a sum of money he needs to deploy, and then now he buy. Of course, he will feel a lot more scared compared to the other person.
Yeah.
But for me, at least, if I share from my perspective, somebody in the so-called mid-late 20s, deploy, because this is not financial advice, but of course, you need to understand the context is I have been deploying since 2020, so the entry is relatively lower. I continue deploying also. It's a function of whether you can find opportunities and weighing out with your conviction on whether you understand the business. And also, my personal opinion at least is, especially if you're in your 20s, the amount of money they're going to deploy is not going to be huge in the grand scheme of things mathematically, assuming that you're a enterprising, ambitious person that continues climbing, continues earning more income. Comparing, I mean, even just taking Bunti's example, investing in the 20s versus now investing in your 30s, going to your 40s, the number, I think, scales quite differently when assuming that you put in money now and next time. Maybe you're putting in 500, 1,000 today. Next time, you're probably putting in 2,000, 3,000, 5,000 a month in that sense. Sorry, not a day, a month. So that's the difference in context, but it helps you build that muscle. So that's why I say I will just continue deploying. Maybe now if I'm working with good size and I'm a bit scared and my income no longer moves the portfolio, then maybe I'll start to get a little bit more defensive in when trying to look at the equation. So there are a few moving parts here.
Yeah. Actually, you brought up a good point. I think especially for those who are new into the market, right? Actually, the hardest things to see, right, is that I just whack some like a sum into a specific investment, right? It could be ETF, it could be a stocks, right? Then you just bought and then it dropped, right? I think that one is like very, very hard. Like you said, if you already built out along the way, right? Actually, it's a lot easier to take in all this volatility. But the moment you bought and then it just dip, that dip could be 3% or 5%, you know, it still feel painful. That amount could be 10,000, could be 5,000, could be 3,000, could be 2,000. You still feel the pain because what happens psychologically is that whatever you just bought, right, you will just look at that thing, right? Just focus so much on that. And then that's why every volatility, especially the down, right, will feel so much painful. That's why you need to weather through the beginning part of your investment journey where you just don't see it and then just let it pass and then you build already. Best is that you don't even realize it. That's why DCA is very good for those who have all these robo advisor platforms, right? They just set auto deductions and they just auto deploy, right? And then you don't look at your portfolio, right? Then, for example, the next time you check is like 18 months from now, and then suddenly it built out to a sizable amount, right? And then in between, of course, there's some volatility. Even with some downwards volatility is also fine because you just don't look at it. So I think that from that perspective, I think the DCA is really, really helpful, especially for those who are, the younger crowds. Yeah.
But I do also like to point out that actually, if you're just starting out, regardless whether you're young or not, but just starting out, I think it's good to go through a bear market, which is actually in my case, to be very frank. When I start to take investing more seriously, not comparing towards when I was investing through my parents, right? So when I came in, very arrogant, right? While you think you're very smart, draw some lines and then trading in and out. I was looking at the US markets as well after the pandemic. You make good money, right? Because wow, very nice. The range bound, buy, hit range, sell, bounce again, buy, then sell, right? So after that, then I, of course, for those of you who don't know, I pivoted to the Chinese tech market and I've sat through a 3 years bear market. From peak to down from my entry, I think in one of my main positions, I was down close to 70%, 60 something, 70%. So that was the peak drawdown. Painful, yes. But I think it builds you into a very special person. So sometimes it feels like, oh, it goes down, only drop 5-10%. A bit lame. But of course, I'm not saying, you can build the same muscle in crypto because crypto also moves very quickly, right? But that's not what I'm trying to say. I think the more key takeaway here is that I think it's good to get these things out of the way. Meaning at least you go through that whole experience, you know what to expect, and then it makes you become more resilient in that sense on what's to come. You know what to expect, and it's not like your first time seeing. I think it's worse for somebody that just sit through an entire bull run. Maybe like let's say after the 2008 financial crisis, they went in, then bull run all the way. And after they build up a very, very sizable portfolio, and then in their 50s, they see that 2020, boom, drop down 40%. I think that's even more scarier for somebody that didn't see to it. I think that's just my personal opinion. But anyway, coming back to this whole overvaluation argument, right? We talked about a little bit about the US market. So I'm not too sure whether you're following, but I know recently you're building up a few Singapore positions, right? Have you been looking at STI, looking at some of these bank stocks? People are saying that DBS just continues climbing up. It's the crown jewel of the Singapore market. Doesn't seem to go down. Are you afraid or are you scared of any of these developments?
I did mention to you, right? My dividend portfolio consists of one bank, which is DBS. So yeah, so I actually don't remember what's my purchase price already, but it's not important here, right? But just talking about DBS, I do feel that that people are talking about it, the share price rally. But in terms of the number, I haven't looked into the details, but my general sense, right, by just based on what people chat about by reading some news article, right, I feel that the banks is generating good numbers. So all the fear about, when interest rate come down, then the profitability will be affected, all those things just didn't materialize, at least as of today, right? So I do think that for me, again, this is my dividend portfolio. My dividend portfolio is not even in my, the daily brokerage app that I open. I don't know what is the amount, like day to day, the fluctuation. I don't look at it at all. I just record once a month only. That's how infrequent I am when checking all these numbers. But I do feel that the numbers is good. Then just keep holding on to it. For me, I'm a happy dividend investor of DBS.
But in a very broad sense, do you find do you find the market getting a little bit too ahead of themselves? I do see online also forums, right? They're talking about some of the more not so high growth names, even defensive names. They can be trading at like PEs of like 25, 30, which feels a bit like we're at the late stage, right, of a bull market where there is a lot of capital, very little opportunities. They're bidding up a lot of the valuations. I think DBS as well, I think it's closer to a 2x book already, like which never seen before in terms of history as well. So what's your thoughts on that?
Let me comment on the price over book for DBS. Okay, I'm not expert in this. I haven't really studied the balance sheet or the income statement in detail, but I know that DBS, their numbers, their income numbers, all these things is doing great, right? It's really because of their wealth management product. So, okay, then come back to why I'm mentioning this wealth management is because when you talk about banks, people value or they use price over book as the valuation metrics, right? The so-called book, right? I guess if not all, right, it will be like majority of them is actually the loan book, right? It could be commercial loan, it could be mortgage, whatever it is, right? That is the size of the bank. And then when you look at the price or market cap, you divide by the size of the balance sheet, you call it price over book, right? So for DBS, if you have one of your arm, which is all the wealth management products, right, doing well, right? To me, is that actually inside their so-called book or their balance sheets? Okay, I think the answer is that yes, they are inside. But you know that all this wealth management, I don't know how they are accounting for it, but definitely the size is not going to be as big as your loan size, right? Because if you look at their balance sheets, I think the loan book is the largest one. So to me, it's like you can see it as like a bank with two different segments. One is like the big balance sheet size, generating a margin which is lower. And then you have a much smaller balance sheet size, which is all these wealth management product, but they generate very, very decent margin for the banks, right? If the second part, which is all this wealth management product generating good result, good numbers, high growth, and then the banks is profiting nicely from it, right? Then of course, the PE multiple will reflect that, and then your price over book will be much larger, right? To me, that make perfect sense. I won't say that, just because their price over book is a lot higher as compared to UOB and OCBC, then you have a problem about that, right? Then you just say that, every dollar of book is the same. When one is priced as double compared to the other, right? Then it is overvalued. I won't make that kind of statement just from that metrics alone. And then we also need to look into the details, because if you look at DBS, how it is managed is also very different as compared to UOB and OCBC. And then the other thing is that when you look at OCBC, I think their insurance business is also like quite sizable, the stake. So that one could actually affect their valuation as well, right? So there are many, nuances there. I think the conclusion is this, right? Don't just looking at one metrics and conclude that it is overvalued. To me, that is like very, very surface kind of analysis.
Agree. Maybe just to play a bit of a devil's advocate, right, for people that are making such comments. I think first things first, we always look at it on a relative basis. So it's true that if you look at any of the returns profile, whether it's ROE, I think that's that's what people mainly use for comparing banks, comparing across the three local banks. DBS, I think, is close to a double and to compare to UOB. I think recently there were some missteps as well. And then they had to write down and there were some problems or issues with the bank. But going back to that, yes, returns profile are very good. That's why they deserve a higher multiple. No problems. But price to book has always been a very historical usage of that benchmark, right? When you look at banks' valuations. And what you just explained, right, which all sounds very logical, but some people might argue that, hey, is it because you're starting to try to be creative in trying to justify your case of something that has been used for donkey years and then now we are not using it because of XYZ reasons? That's one. And also, secondly, when you look at it on a relative basis, like comparing DBS, which is a very respectable bank, but comparing it to, let's say, our US counterparts, your big banks, Goldman Sachs, JP. If I'm not wrong, I just did a quick search. Actually, DBS is more pricier compared to Goldman. Like Goldman has a big investment bank arm. You can make the same argument of like why it deserves 2x price to book as well, right? I don't know. I just feel like people, I think it's justifiably so why people are nervous or people are scared that when they are dealt with this kind of things, the instinctual thing is, okay, this is getting a bit out of hand. Do you have thoughts on this?
I would say that, let's say if you compare against other banks, right? First thing is that you name any banks, right, outside of Singapore, then the first thing is that, okay, they are different in terms of their market. So different markets, when it comes to their loan, mortgage, their practice could be different. So that one, you need to account for that. So sometimes even the same PE, same price over book, they are not comparable just because of the markets, they are different. Okay, this is definitely one thing to caveat before you do all this comparison, right? Second thing is that you need to understand the compositions of their business. Say, for example, DBS, what's their loan book, right? Who they lend their money to, right? Versus, let's say like you mentioned about Goldman Sachs, right? Investment bank. Investment bank's business is different compared to commercial bank. They are simply different. I would argue that, let's say if you think that now economy is kind of like peak and we are going downhill, right? Then you want to stay away from all these investment banks, because investment banks, they can make a lot of money when market is having a bull run because of IPO and so on and so forth, right? But when it comes to recession hit, right, suddenly they have no business and all these bankers, they need to, they are even losing their job, right? So all this, the cyclicality, which segment will be affected more, you also want to, take that into considerations. I think at least for DBS, UOB, actually all three banks are in Singapore. In terms of their market practices, I don't think they are doing some sort of crazy, like just keep on giving out loan without due diligence. I don't think so. I think they are more towards the conservative part as compared to overseas banks, right? That's overseas bank, I mean the practices in other countries. So you want to take that into consideration. So all in all, I will feel that, again, this one requires some sort of expertise when it comes to, commenting on this. I'm not the expert in this area, so I will just refrain from commenting too much. But I will say that for every comparison that you try to compare, I will say that there are nuances there that might justify it. So I will tend to think that, yeah, it's just, market doing its things. People are bullish because the result is good. That is the simple explanations, right? So I don't want to think too much outside of the box.
Okay, so the ultimate question then coming back is, should we stop buying stocks and what do we do from here?
We are circling back to the same question again, right? So stop buying stocks or not, come back to that questions that I say, right? So for me, I would say
yourself,
generally I'm feeling okay with the market, even though people are saying that, oh, now we might be having a recession next year. Then actually I want to tell you, every year you might be having a recession next year. So this statement cannot be false one, right? So then is that the reasons of not buying? Then it to me is not a good reasons, right? So the question is not to predict whether the market will go down next year or not. I think that is not a good question. The more useful question is that,
what is your CAGR?
No, the question is that, what do you do about it? Yeah, I think that's the questions. Because some people, what do you do about it is more like, okay, what's your strategy? Because your strategy should be flexible enough to navigate all sorts of environment, right? Let's say market down, what do you do? Market up, what do you do? So you need to come up with some sort of rules to guide your decisions. I think that is a lot more useful as compared to, wow, should we stop buying? Should we keep cash now? So that is just simply not useful.
Okay, I think that's a very good note to end the discussion. Feel free to leave in the comments on, are you continuing your journey to buy stocks? And with that, we'll see you guys in the next video. Goodbye.